Hey everybody, Tyler Stofel and Associates Realty. Welcome back to another Thinking Thursdays. This is our 7th episode now, so I hope you've followed us since numero uno. It has been a great process to be able to provide you guys with education and insight on the industry and everything that's going on as a whole. So with this being the 7th episode, we haven't talked about, but we're actually going to go ahead and speak with today is the real estate lingo. So for people who aren't in the real estate industry, just a few key words here today that maybe you don't have an understanding of or would like a better understanding of. So we're going to go ahead and talk about 5 different keywords today that we deal with a lot as real estate professionals, and hopefully shed some insight onto you. So number one that we get, probably the biggest one, is on equity. What is equity? How does equity work? What does it do? What does it stand for? What is it? So equity is basically the amount of positive money ownership in a home. So equity would look like a house that you owe $200,000 on that's worth $250,000, or a house you just purchased for $200,000 that appraised out at $220,000. That difference is equity, and that's positive equity. There's also negative equity as well. So negative equity would be, if you're upside down on your home, meaning that the home value is worth $200,000, but you still owe $230,000 on your mortgage. Equity is a wonderful thing. That is how a foundational block of success and financial freedom for a lot of Americans, and it's essentially kind of a savings account. Generally speaking, real estate is a pretty safe bet on where to put your money. It's not a liquid kind of investment. It's illiquid. But with that being said, if you're paying a mortgage every month, you're paying it down for the years, you are going to build equity no matter what. And even if there's a few dips here and there, generally speaking, real estate always comes back. Next one is appraisal. What is an appraisal? An appraisal is basically a licensed appraiser that comes out and checks the value of the property. So the big thing about it is that we don't want to go ahead and sell a $500,000 house to someone that's only worth $200,000. So that third-party appraiser that's not affiliated with the bank or with the real estate agent is actually going to come out and give an unbiased opinion on what they believe the value of the property is. Now, if you're working with a trusted professional, we can't necessarily perform appraisals, but what we can do is actually CMAs, which are competitive market analysis. And generally speaking, we're usually pretty close, if we're doing our job, to what the appraisal is going to value. And in a perfect storm, the appraisal actually comes out higher than what the offer price is on the property, and that's what creates that instant positive equity. Next thing is a pre-approval letter. We get a lot of people that come into our offices looking to buy a house, and one of the biggest things we ask them is if they have a pre-approval letter. And a lot of times they're like, I don't even know what a pre-approval letter is. What does it do? What does it not do? Basically, a pre-approval letter is a letter from a bank or a mortgage brokerage or whoever, basically from a lending institution, stating that you're eligible to purchase X amount of dollars worth of property at certain percentage down at this rate, and so on. And generally speaking, a good lender will go ahead and check your credit, they'll check your debt to income ratio, and they'll check a few other things to make sure that you're not just saying, hey, I got a 620 credit score and I've got $20,000 in the bank, I want to buy a $500,000 property. Well, that's great, but there's a lot more logistically to that. So pre-approval letter is paramount because it shows the real estate agent that you're working with that you can afford the house, and it also shows the seller that you're serious about purchasing because you've already taken the necessary steps to go ahead and move forward to getting a loan for the property that you're interested in. With that being said, the next important thing is a down payment. So the big myth, and it's really crazy that, that the 20% myth of having to buy a house, and for some reason, I don't know, maybe it's embedded in everybody as a child, or it's just how we're raised, or whatever it may be, but for some reason, everybody thinks that 20% is what is required to purchase a house. And the latter could not be true. The only positive thing about putting 20% down on a house is, of course, having more equity in it and not having to pay private mortgage insurance. But aside from that, you can get a house for as little as 3% down. If you're a veteran or you're buying in a rural area, you can get as far as 0% down. And there's also a lot of down payment assistance programs out there as well that help with the 3%, the 3.5% down, Generally speaking, first-time home buyers we work with a lot, and we usually see a 3.5% down. There's also 3% down as well, but for the most part, most of our sales and transactions are between 3% and 10% down. It's probably 1 in every 5 deals that we actually have someone put 20% down. So if you're looking from an affordability standpoint, and you're looking at maybe a $100,000 house or $200,000 house, if you take the first, last, and security that you would be essentially doing to rent with, that could make up for your down payment. And then lastly, to follow up with our real estate lingo, is closing costs. So a lot of people think that the down payment's all you need to purchase a house, when in reality there's actually closing costs associated with it. And closing costs are generally rule of thumb. If you're looking at a conventional loan, we usually say 4% maybe. FHA 4 to 5%, and VA about the same, 4 to 5%. Now, of course, that is a very broad spectrum, and we will work with the lender to get the actual realistic numbers. But if you have enough money for your down payment, but maybe not necessarily enough for closing costs, we can actually negotiate with the sellers to get them to help cover most of your closing costs, if not all of them. And there's certain federal guidelines that allow us to maximum contribute, like conventional with 3%, or FHA, which is the seller's allowed to contribute 6%. So if you're looking to get into a house, you're looking to take advantage of these low interest rates while they're still low, keep in mind that when this vaccine comes around and it starts becoming more universal and more widely accepted, that the housing market, the economy itself is going to be stronger, and in that case, the Fed is going to raise interest rates. So I would imagine that probably by second quarter next year, third quarter, we're going to start to see those interest rates rise. So the good thing about right now is that if you're able to afford a property, you're able to get into it, and you can do it before then, you're going to take advantage of some of the historic lows that are actually going to be in the market for the next few months. I hope you guys learned a lot of information today. Stay tuned for next week when we will unveil some really solid information as well. And thanks for tuning in.